Hi there, and welcome to the Business Growth Factor. My name is Lyndon Smith, and I'm joined today by Joshua Lyyenhorst. And today we're going to be discussing profitability metrics, specifically looking at gross margin and net profit margin and why these actually matter. A quick introduction about to myself. My name is, as I mentioned, Lyndon Smith. I got a company called Expansive Edge, and we work with small to medium-sized businesses, and we help them organize and scale their operations. We do this by creating a business playbook and creating a knowledge hub for their team, for your team to access, consume, and contribute to. I'm going to hand over to Josh for a quick introduction and just also to introduce our topic for today: why profitability metrics matter.
Awesome. Thanks, Lyndon. Very nice introduction there. That was well said. I feel like I can't really follow that up, but I feel like I need to practice more, maybe. So I'm Josh Lyyenhorst. I am the principal at BasePoint CPA. We're a cloud-based CPA firm. We specifically focus on helping businesses have a profitable and growing business. And so that's through virtual CFO services. And basically, it's like GPS for your business, really guiding you along the profitability journey so you know which turn to take next on a month-to-month basis. There we go.
I like it. Navigating you through your profitability challenges.
Nice. Thanks, Lyndon. And that's a good tie into the topic that we're discussing here, profitability drivers. So, so I mean, as far as like profitability, why does that matter? If we're not profitable, then I guess it's not really a business, right? I guess it's a hobby.
Absolutely. Yeah. For this conversation, we've identified two kind of metrics that we want to touch on and just dive into. And the one is gross margin, and the other one is net profit margin. Can you maybe lean into why these particular metrics, why they matter, and just give us an overview on what the difference is between the two?
Yeah. So gross margin and net profit margin. So you probably heard these terms before. They get thrown around a lot. What do they mean? Your gross margin is basically the difference between your revenue and then your cost of goods sold on a percentage basis. So, the easy example I'll always kind of use in generic terms, like if you sold shoes and you sell a pair of shoes for $100, but your cost to buy that pair of shoes that you just sold was $20, that means your gross profit will be $80, right? It's the 100 minus the $20 of your cost. So it's $80 is your gross profit. And then you divide that by your revenue. That's a percentage basis now to be 80%. So you have an 80% gross profit margin. That's kind of the idea behind what's that?
That's pretty healthy.
Yeah, that's a healthy margin. We like healthy margins like that. Retail, usually you want to have like 50, 60% if you can. There's a lot of benchmarks out there. We can talk about that sometime in the future. But so that would be your gross profit margin. So there's gross profit and there's also gross profit margin. The margin is a percentage calculation. And so it represents the profitability of the delivery of your products or services. So when you have a business, I mean, your business is there to effectively provide a good or a service, or maybe both, right? And so how profitable are you in the delivery of the goods or services that you're delivering? That's your gross profit margin on a percentage basis. Then your net profit margin is going to be how profitable you are after the business operates, right? Because you're not just delivering your products and services, you have a business that supports the delivery of it, right? You've got a building, you have vehicles, you have professional fees, you have very expensive people like ourselves that help business owners along. So these are all overhead expenses that are necessary to keep a business operating so that you can
keep the lights on.
Exactly. It's to keep the lights on. Exactly. And so those expenses are overhead. And so when you look at an income statement, we have a webinar on this, kind of understanding your financials. This section of the income statement below your gross margin or your gross profit line is often called like your expenses or your general and administrative overhead, or G&A. Some people call it a selling general and administrative overhead, or SG&A. Okay, lots of terms out there, but it's the overhead type expenses. What's that?
All these acronyms.
All these acronyms that,
Yeah.
we end up having, they just kind of like flow off our tongues, and people are like, what was that? Like, what are you talking about?
It
It's like,
makes
oh, right.
finance a little scary, all these acronyms, but it's not as bad as what people think, I guess.
It makes
Yeah.
it sound scary, or maybe like nerdy. I don't know. But so then that section, then, right? Like your G&A section is that those are your overhead expenses that, yeah, like you say, keep the lights on, keep the business functioning. And so the difference between your gross profit, the profit after you sell your goods, and then your expenses are going to be your net profit, right? That's how much, that's the monetary amount in dollar figures that you take home at the end of the day. Shouldn't say that you take home at the end of the day, because within there also you're going to have things like amortization, which is actually not a cash thing. So you're not actually taking home. It's not. Yeah. Anyways, I digress. We can talk cash flow in another one, but that's your net profit. So then, if you divide your net profit by your revenue amount, then that gives you a percentage basis as well. That's your net profit margin. And so your gross margin will give you a sense of how profitable you are in the delivery of your products and services on a percentage basis. Your net profit margin shows how profitable you are as a business as a whole when everything's said and done.
Okay, excellent. So that kind of answers the question that I had. Is like, why do these metrics actually matter? What is it that that they're telling us? So that was a good lean into that. Thanks, Josh.
You bet.
So we were talking about the gross margin being, what the cost of your operations are. So what the cost is, it's your revenue less cost of goods sold, effectively. Um, How do you tie this into? It goes into the conversation we were having before. You've got your projects that your business would run, and then you'd have your business. So each
Mm-hmm.
project. I mean, I'm just coming from a project management perspective here.
Mm-hmm.
Your projects, you'd have your gross and net margins on your projects as well, and then you'd have your fixed or more variable costs, based on what you've budgeted and cost overruns. However your project is performing, and how that starts impacting your margins for your project, and then how that actually starts impacting your margins for your business as well.
Mm-hmm.
Any thoughts around that?
Yeah. So when you have, like, say, a construction company or a company that has a number of different types of projects on the go, yeah, each one is going to be sort of like a profit generator, right? And
Mhm.
so, as a project manager of a particular project, you're accountable for the profitability of the project. And so, you want to be looking at the revenue that's coming in, but then you have, like, say, you have expenses, which are all going to flow through cost of goods sold, right? So, you'll end up with the profitability uh, margin at the end of it, which essentially feeds into your gross margin at the end of the day for the company.
Mhm.
But yeah, you want to be aware of what those costs are. And so when you're starting, like, day zero of a project, your profitability is effectively your estimate, right? You're like,
Yeah.
hey, this is what our bid price was. It's X dollars. And then we have a breakdown of what we anticipate for our expenses. That's our profitability. If everything shakes out that way, then great. So maybe like 20% gross margin or something.
Yeah.
It's like, great, that's how it all worked out. But things never go as planned, as we know. If somebody says yes, they do, then I'd like to have a chat with them, because I'd like to figure out how that works. But there's things come up all the time, right? And so, what's important to do, especially if you have projects that span over multiple months, even years, is on a monthly basis, if you can, is just to revisit the actual expenses on your project and see
Mhm.
how they're tracking with your estimates. So if you had, you know, I live in northern Canada, so we have a temperature issue here. Yeah, you live in Calgary, so you get a proper winter too, right? If you have outside projects, like, or even like a new build, that's not quite outfitted as far as, like, all the electrical and mechanical, your HVAC units in there. Like, if you're working inside, you may need temporary heating in there, right? And so that's going to be, while you're working in the space, you have temporary heating that you have to deal with. And so maybe you budgeted $10,000 over the course of the project for temporary heating, but then we have like a really horrible winter that happens to be way colder than normal. And so, 6 months into your 8-month project, you realize you're at $15,000, so you're $5,000 over your initial estimate on that line, right? Now you start to realize that your profitability, your margin on the project is going to change. And so it's important to revisit that. I would suggest on a monthly basis to make sure you're adjusting your estimate in order to better understand your profitability. Because it does help in augmenting decisions too. You're like, maybe we won't be as liberal with some of the other expenditures that we might otherwise have on the project because we're already eroding some of the profits.
And this comes from experience. I would imagine the more estimates that you've prepared, the more projects that you've done, that your business has done, you would know what to factor in and
Yeah.
much to factor in there.
And it's a systematic process too. I mean, if you actually have the disciplined time and you do it on a monthly basis and you look at your estimate and you take the costs, I mean, you have to stay on top of your accounting, make sure your accounting is always up to date. But if you have your costs in the system, you can go through it and be like, okay, how much have we spent on this? How much have we spent on this for each project? So you can constantly update your estimate. Doing this also, this is kind of a side note, but very important. Doing this also helps make sure you've captured any potential change orders that you might have to also issue to your customer, right? Because maybe, in the course of the work, maybe one of your trades is like, oh, hey, like this came up. We need to issue a change order, a CO for this. You're like, yeah, no problem. Now that's an additional cost for you, right? You're like, ooh, I forgot to account for that in my billing for this particular month for the customer. And so it helps you track things like that as well.
And it's, I mean, that's the value of bringing on project managers, project coordinators, and a team to to ensure that you're staying on top of that, and not that the scope creep doesn't get out of control, right? And that you are actually invoicing for those change orders and getting them approved, and just running through that.
Otherwise, it's an awkward conversation 5 months down the road, being like, "So we had this change order that came up. Can we squeak that in at the end here?"
Yeah, no, absolutely. I think a lot of project managers would would relate to this conversation right now.
Probably had it once or twice, yeah.
At least once or twice. All right. So we've done a quick overview on like gross and net margins, and you've given us an overview on how to calculate that. Really, just high level overview. Something we were chatting about earlier was, salaries and wages, and where does that belong? Is it in your calculation for gross margin or net margin? I guess it would depend on the company and how they've got things structured. I think a good rule of thumb was, anything that's an overhead for keeping the lights on, so to speak, is your accounts or admin department, sales, marketing, anybody that's not out there doing billable work. That kind of fall into that net margin calculation. Whereas anybody that's billable, guys that are in the field that are being charged out at a rate or at a value, they would fall into the gross margin calculation. Any thoughts around that or anything to add?
Yeah, that's a good summary, Lyndon. It's not something that's consistently applied across all businesses, and so that's always a challenge. I mean, we see all sorts of ways in which people do this. Sometimes consistent, sometimes not. And even Industry Canada actually has a small medium enterprise benchmarking tool. That's a super handy tool to get a sense of how you're performing with respect to profitability margins. If ever you wanted to play with it, we can maybe put a link to that in this episode here for people. But so you can kind of see, you're like, okay, well, I'm like, say, maybe our company is like 15% margin at the end of the day. How does that compare to other companies our size in the industry? Now, the challenge, if you end up using that benchmarking tool, is you will recognize that it also includes a whole bunch of information of companies that don't do this consistently. And so if you look and you're like, ooh, my gross margin is way off, but my net profit margin is fantastic and comparable, it's probably because of things like this, particularly where you might have a lot more staff costs in your cost of goods sold. So if you have like an electrical and mechanical contracting company or millwork company, you're going to have a lot of heavy material costs. But if you're like a demo contractor, for example, a lot of your costs are going to be your people. And so in that situation, where you put your cost of goods, your payroll, whether it's in cost of goods sold or overhead, makes a big difference. And so generally, as you say, Lyndon, like, yeah, having anything related to the delivery of your products or services, even with payroll, should be in your cost of goods sold, because then it gives you the best picture of your profitability. Because if you don't have it in there, maybe you're looking at your gross margin because now you know how to calculate it because we've talked about it. If you're looking at your gross margin, you're like, hey, we're doing really, really well. But then if you take your payroll related to the delivery of products and services and put it in there, you're like, ooh, that actually doesn't look so great anymore, right? And we still have to keep the business going. And so that's why, as much as possible, you want to get project related costs into your cost of goods sold so that it factors into your gross margin. Just really quickly, one last thing to consider in this is the idea of allocation of overhead expenses. So if you have all your team has a cell phone, right? Your cell phone bill every month could be like $5,000 plus for the company, right? If that just ends up sitting in your telephone expense, in your overhead expenses, sure, it brings down your net profit margin. There will be no difference to your net profit margin whether or not it's sitting in overhead or cost of goods sold, but it's primarily for your team, and that is impacting the profitability of your projects, right? And so it should try to be, you want to allocate that to, which there are ways to do that. We can dive into that another time though.
Yeah, absolutely. Super. So I just want to maybe take us back to, the good old saying, your revenue is vanity, profit is sanity, and cash flow is king. A lot of people are always looking at the revenue metrics, so revenue as a metric. Why is this more valuable? What is there? It's not telling us anything about cash flow immediately, or at all. It obviously contributes to our cash flow, but why is this metric, gross and net profit margin, like, why is that valuable?
It tells it, what do I say, the numbers tell a story. It tells a more complete story, right? Because, you can say, oh, hey, we have a $50 million company. And it's like, that's very impressive. You do $50 million of work every year. But what do you take home at the end of the day? That's kind of the question that really matters at the end of the day, right? And so that's why it's important to understand these two metrics. And we'll get into it in a little bit here, but like, that helps you then diagnose where you might be having profitability challenges. So you can have high revenues, that's fantastic. And that's why it's like revenue's vanity, right? It sounds great. $50 million company, we built this, right? It's great. But profit is sanity. It's like, it kind of brings it down to like, is this reasonable? Does it make sense to have this big business? Is it making the profit that one would expect for the amount of work that's going into it, right? Then at the end of the day, you got to make sure you're still getting the cash out of it, but that's a separate topic altogether.
Yeah. So I love what you say there. So it's we've got a $50 million company. You're always going to be looking at that as a revenue metric. You're not going to say I've got a $50 million
That's
profitable
right.
company.
Yeah. Actually, quite often people will hold that number closer to themselves, the actual profit number.
Yeah.
And it doesn't sound as nice, right? That's why the vanity number is the high number.
The vanity number. That's exactly it. Right. You deal with clients and it's like, what's your revenue? And they'll share that openly, but
Yeah.
the margins or the profitability metrics that they're looking at, they might not even know it.
Yeah. I mean, the revenue number will oftentimes indicate like the level of the scope of the size of the business, right? Because you're like, okay, well, if you're doing $50 million of work, you probably have X number of employees, probably have these many vehicles, right? Like you get a sense of the size of the operations of the business at that point as well.
Yeah.
But yeah, profit. At the end of the day, you want profit and you want to be able to collect it. So cash flow at the end of the day.
Yeah. So Josh, when we're looking at profitability in a company, so let's take a $100 million company, for example. We're looking at a revenue metric there. How do you detect or diagnose that they have a profitability challenge, for example? And how do you link that back to some of the earlier conversations around driving your pipeline, and maybe we can kind of lean into that conversation a bit.
Yeah. So, and these types of, I mean, profitability challenges happen like for every company is going to bump into it at some point. There's different reasons behind it. Having a constant pulse on this is super important. There are a lot of businesses out there where the owners just kind of look at their financials at the end of the year. They're like, how did the year shake out, right? So what I would highly recommend is from your accounting system, and most can do this, pull out what we call a monthly comparative income statement. So you basically pull your income statement out and have it broken down into months. So you can see month over month how your profitability is looking. And then you can see changes. And so you're like, okay, it feels like we're not making as much money as we should be. Why is that? That's a
How far
profitability
back would you
question.
go?
What's
3 months,
that?
6 months, a year?
12-month rolling basis is typically helpful to get a pretty good like recent picture. I mean, you can go back 5 years, but that's irrelevant at that point, kind of thing, right? So 12-month rolling, I think, is good. But then if you're getting the feeling that, or the sense that you aren't as profitable as you should be, this is like where you can start to diagnose it. And so get that monthly comparative income statement, and then look at month over month and look at your gross margin and be like, what is our gross margin doing? If your gross margin is going down right off the bat, that could impact profitability. Unless all of a sudden you're trimming your overhead costs and maybe you'll level out on the net profit margin level. But always look at your gross margin first, because that's the kind of thing that as you're scaling up your business, you're scaling up your operations, efficiencies come into play there, and it's something that you're probably a bit more familiar with in terms of like how to do that. But when you look at your gross margin month over month, if there's changes there, you need to ask why, right? We've seen this with materials costs in construction over the last 5 years, like fluctuating before, during, and after COVID. I mean, materials costs have been all over the place. So you've seen some massive fluctuations in gross margin as a result of that. Payroll for your site team, this is significant, right? When you have large trade unions that say like impact the HVAC industry, for example, come up with a pretty significant raise anticipation over the next 5 years, that ends up impacting a lot of the other trade scopes as well. And so you'll start to see bump ups on your payroll expenses as well. That's going to decrease your gross margin. So pay attention to that. If your gross margin is pretty steady, then okay, we're experiencing lower profits, but our gross margin is steady. That means it's happening below our gross profit line, right? And so it's in our overhead expenses. And so then you want to be looking there. That's where you would be diving a little bit deeper to see where those expenses are coming from. And those are going to be, again, your overhead type expenses, right? So it's going to be, subscriptions are classic. We call these the set and forget expenses, right? They're like those things that you pay for certain subscriptions for software, or maybe that you start using and you kind of forget about, right? So this is why, again, if you do this on a monthly basis, you look at your comparative monthly income statement each month and look at each line, you're like, ooh, right, that line has a lot more in it than it should because we forgot to cancel this particular subscription or cost that is still continuing, right?
That happens so often on projects where someone needs software to deliver certain components of a project because the client has it as a requirement. Subscribe and then forget about it, and then 3 years later you're still paying for the subscription. Nobody's using it, or the person that originally subscribed to it has left the company, and
no one's using it. Yeah, exactly. So it's good to look at that, and so that's a very good practice. And if there's one takeaway, I mean, this is maybe jumping the gun on takeaways. I'll leave it for the takeaway. We'll get there later.
Sounds good. Cool. So we've chatted about about quite a bit here. I had another question here for you. Sorry, maybe some strategies around improving your gross margin and your net margin.
Sure.
Some of the notes that I got here was supplier negotiations. Where does that fit? That would be sort of gross margins, right?
Yeah. So your supplier is going to be, well, for the most part, right? You might have suppliers that supply things that are related to your overhead. Like maybe you have a whole bunch of office, like, stationary type stuff that you always get from a supplier, right? So that's typically going to be in your overhead, or your general administrative overhead expenses. But like material suppliers, building supply stores, all these things, primary vendors for equipment that you're selling, like reselling, Yeah, negotiations there are pretty key, right? Making sure that you have good relationships with your suppliers is pretty important.
Yep.
A good way to do that is make sure you pay them on time, right? As soon as you start paying your vendors and suppliers and trades later, they are going to price you higher, and that's going to erode your gross margin. So that's important to consider for sure.
And they typically offer some discounts if you pay earlier
Yeah.
or if you're buying in bulk and you're paying
Yeah.
on time. Yeah, absolutely. Um,
Yeah, the buying in bulk is a good, that's a good point, Lyndon. Like if you can anticipate that you're going to need a bunch of materials for something, and if you have the capital available to do it, like that's a good opportunity to bring down your costs there, for sure. And those early payment discounts are pretty significant. They some of those, if you calculate it out to an annual basis, amount to about 18% interest equivalent. So depending on the nature of the discount, but yeah, oftentimes those are a good thing to do too.
yeah. And I think that goes back into like that whole cash flow conversation. If you've got the cash flow to be able to reduce your expenses or just like increase like your profitability margin, you could do it in certain areas of the business and have a pretty significant impact right on the bottom line.
Yeah, for sure.
Um, yeah, sorry, I had a bunch of notes here and I've just lost them.
Yeah, no problem. So we were just talking about strategies to increase your different margins.
Oh yeah, if you had something to say there, I'll leave you to continue with that.
Yeah, so some things to consider, just kind of higher level even is like, okay, so we're seeing an erosion on our gross margin. Maybe there's a pricing adjustment that's warranted, right? I mean, it's always hard to increase prices, right? But it's a reality. And if you look at your expense lines, those are certainly usually increasing. So other people are doing it. Um, there's other cost drivers that businesses have, and in Canada in particular, like the increasing impact of say like the carbon tax, which doesn't have a credit tied to it. That's an ongoing
Yeah.
increasing cost, which erodes profit, and so as a result companies end up having to increase prices to maintain profit margins. And so if you look at your expenses and they're constantly climbing, but you are seeing eroding profits, you may want to reconsider your pricing. And even in construction, just being aware of what some acceptable benchmarks are for price per square foot on certain types of projects. If you can benchmark that for your own company, that's super helpful. So you can see how you're typically pricing, right? If you can break it down to that.
Yeah, I think that's a great point. It's always just going back to what the industry benchmarks are. So you mentioned that you got a link that we can share in the
Yes. Yeah.
yeah,
We'll put that in
we'll
the
share that in the comments section of this whatever format you're listening to this in.
for sure.
Or you can find it on our website as well. We're going to build up those pages for each one of these episodes, and we'll have that those resources available there.
Awesome.
One last question, Josh, before we start wrapping up here is so we've looked at in earlier conversations, a cash flow, revenue. Now we're looking at specifically gross margin and net margin. I wonder, are there any tax strategy or tax considerations, when looking at like your net margin, for example, and how to start maybe offsetting that or reducing your tax liability? Any, maybe not advice, but any considerations rather?
Yeah, I'll maybe preface this by saying this is not tax advice. If you need tax advice, talk to your accountant, which we can help with, but don't take this as tax advice. So your net profit, which is again, is going to be the difference between your revenue, then your cost of goods sold, then all of your overhead expenses gets you to your net profit. In a corporation, that is an approximation of your taxable income, off of which taxes are calculated. So without getting hyper nerdy on it, there's a Schedule 1 on your corporate tax return, which does some adjustments, which take you from your net profit from your company to what's called taxable income. That's what you pay tax on, is your taxable income.
That's what should go into your tax account if you listen to the earlier one of our previous episodes.
Yes, that's right. Yeah. So then you'll know what your actual taxable amount is. And if you know what your corporate tax rate is, then you can kind of determine what your taxes are. So tax strategies, I mean, I get a little bit hesitant to give any in particular, but at least if you know what your net profit will be, it I always say, like, the numbers tell the story. And so if you know what the story is, you can best write the next chapter. And so if you're like, hey, look, we're going to have a whole lot more profit than we need. We've been thinking about purchasing some of these things for the company, or, we've been thinking about this bonus program that we wanted to do to incentivize our employees. I've been thinking about some equipment that maybe has some really good tax credit uh, um, opportunities that are tied to them. Sometimes the government will incentivize purchase of larger equipment. We saw that especially even during COVID. Um, then you can make decisions based on that. You're like, okay, so our net profit is X. Let's try to bring that down a bit, or
Yep.
I should say our anticipated net profit is X, because if you do this after the fact, it's too late, right? So this is why, if you can keep on track of this on a monthly basis and know your numbers, you can forecast out where you think you're going to be landing. And then you can make some of these decisions before you get to your year end. So it would be applicable to your year end from a tax perspective.
Yeah. All right, excellent. So, I mean, there could be different investment strategies that you can consider based on those numbers, knowing what those numbers are, and just have a good solid financial plan moving forward for your business.
Yeah, for sure. And even if your company has like a charitable arm or something, right, where you maybe give charitable donations, and it helps to know how much you want to be donating. If you do profit sharing as a company, right, it's good to know what your net profit will be at the end of the day, or what your forecasted net profit will be, so that you can create your profit pool, which is then distributed through your profit sharing program. So certainly very, very important base number to use to make a lot of different decisions. But understanding, that difference between your gross margin and your net profit margin, and what's driving each of those, is very key.
Excellent. All right, Josh, we got to wrap it up here. You mentioned you had a key takeaway or a takeaway for today. Do you still have it there?
Yeah, so I think it came out of what we were talking about earlier, with like the monthly comparative income statement, reviewing that regularly. And then if you have projects that span multiple months, doing the same thing where you look at your expenses against your estimate and revising your estimate each month, so that you understand what your actual anticipated profit will be on the project, is super important, because you don't want to find out after the project is done how profitable you were, right? It's best to know on a monthly basis how profitable you are and are expecting to be, so that you can have the agility to make the decisions to optimize and augment where needed. And so that's at the project level, and then also at the overhead level. And so if you look at the monthly comparative income statement, compare it, see the trends, see how you're tracking from a gross margin perspective, a net profit margin perspective, and look for any anomalies in any of your accounts, because you can track them and deal with them almost immediately, rather than, again, if you just look at it on an annual basis and then you're trying to backtrack and fix things after the fact. So that would be my big takeaway. Monthly, make it a monthly system that you implement in your business.
I love it. Yeah. So just looking at your actuals versus your estimates, your profitability there before, during, and after projects, right? So
Yes. Yeah.
you're always sort of keeping on track on that. And I think just one last thing before we wrap up here is implement data-driven pricing and cost control strategies, because that can help you protect your margins. As you're
Yeah.
forecasting and budgeting in future, building out those estimates. And you at least make that data available to your team as well when they're preparing and bidding on projects.
Mm-hmm. And I should say as well, Lyndon, I think it might be important, and this is a totally different topic, but it's very relevant even to this conversation, is looking at where efficiencies can be found in your business is also a very key way to, like, an important strategy to optimizing your gross margin and net profit margin. If you are not running an efficient business, you are bleeding profit and therefore cash. And so systems in your business are key.
And on that note, I'm going to wrap us up there, because that is our next episode for the business growth factor that we're going to jump into. So
Nice.
to our listeners, our next episode is going to be looking at efficiencies and workflows to be able to drive your profitability. Um, from Lyndon and Josh, just want to say thanks again for listening and stay tuned.
Thank you.
Cheers.